Hello and welcome to another article video, and this is the final video that I'm doing for this blog articles. So as you know, every article has a blog. No, every blog has a video. Okay, that's what I meant to say. And if you're new to the channel, welcome. My name is Meydan. I'm a finance professional and a fintech entrepreneur, and we calculate the future swing days and the trading hours of the day with a pricing model. All right, so and let's see how this article is going to be. So this is called The Art of Trading Breakouts with Time Price Trading. Remember, if you're new also, you should know that I'm looking at everything from a time and price perspective. So all my blogs, all my videos, everything is taken care of every trader problem from a time and price perspective and solving them all. And if you are trading and if you're interested, you can find a bunch of articles here, as you can see, and all of them, nearly all of them actually have a video as well, so you can check them out. So let's, without further ado, get into the art of trading breakouts with time price trading. Now with time price trading, obviously what we have to first know is technical analysis, right? Without knowing technical analysis, without having a precise pricing evaluation, timing the trades is going to be a bit ineffective. So we need to have time and price together. So what we want to do is understand that breakouts are not going to happen randomly. They're going to happen when there's some kind of volatility, and we can measure that volatility if we bring time and price together. So the important thing here is to measure them both. Now a lot of people, when they talk about breakouts, they draw the lines and then they see a breakout, and if there's volume behind the breakout, they like to push through, which is fine, and technically that is how it should be done. If there's a breakout with volume, then you understand that that's the place to go in. However, though, there are many fake breakouts as well. So in order for us to understand what's fake and what is not fake, we can use another variable which is called time. So if I use time, which means the pre-calculated swing day and the swing hours, the trade hours of the day, to the hours and minutes, then I can actually trade much more successfully. This will avoid late entries. It will avoid all this whipsaws, getting fake breakouts also, and you'll also be less stressed out because you're looking at a time and price correlation, so which means that highly likely you're going to have a good trade, and if you don't have a good trade, it's going to be minimal loss, because if time and price are wrong, we don't want to be in that trade. So what do we want to see? Well, we want to see time and price forecasting. First of all, we need that to be calculated, and once that's calculated, we want to trade on a swing day, swing hour, and see how the market's going with our pricing model. And the previous video I did it today as well. Let's just check it out, because I talked about entering the euro dollar trade there. Why? Because on the euro dollar, I know that today is a swing day, but today is a holiday in the US. So with the euro dollar, I've got Thursday and Friday being a possible swing day, right? Which means that on the daily, if I take a look, euro dollar is down. So I want to buy at places where I've got some decent pricing and timing together. So I just recently entered the breakout here, which corresponded to, as you can see, the trading hour. All right, so if I take a look at this, I'll make this a little bigger, right? So these are the trading hours. As you can see, the market going up from here. Here's another trading hour market going up from here. Here's another trading hour market slapped down from here. So with these trading hours, as you can see, we're getting volatile action. If our bias is to the upside, what I want to do, let me turn this into a 15-minute chart so we can see more data on the same page. You can see I've got all these trade hours here. So with the euro dollar, what I want to see myself entering at the right price and time. So this was a price which we had anticipated before, so the market picked up at this trading hour, so like we're good to go up, and it broke out here as well, and I actually entered the trade here with a tight stop loss. This is the low of yesterday, so the stop loss is basically just at that line, just slightly under that line. The reason why is it's already done that, it's already sweeped it, so if it does go up, it shouldn't go any lower because it's been there. All right, it's been there once, twice, 3 times, so, and it hasn't broken any lower. It still can, because I've got 14.13 here, which corresponds to a weekly PST price, which is 63, as you can see here. That corresponds to a price of 14.138. So 14.14 here, as you can see, 14138 is also a logical target for the week for the market, and if it comes down there, I will still want to buy the euro dollar, especially if it does so on a Thursday or Friday, because Thursday or Friday is a swing day, right? So on those swing days, I am wanting to go up from here. And as you can see, I've got 2 positions here, one to cover the trade, the other one is to take profit. And how do I know where to take profit? Because I've got an upper line here. This is on the daily. It's 64.71. That's the price of 16.20. So I've got 16.20 as a second target if this goes in my direction. Right, as you can see, it's way up there. All right. So I've got a small risk. What's the risk? $86. If it works out, what I need to do, let's do this. $86 is risk, so I need to bring this down a little bit more. That's the 86. So if it goes in my direction, this will cover the trade. If it doesn't, I've got about $180 loss. If it goes in my direction and the market keeps pushing up, that is, as you can see, 713. So it's just about 1 to 8 risk return. All right, so it's not too bad at all. All right, so this is now trading hour as well. Now exactly what hour is that? That's 15:05. Yes, 15:05. All right, so if I go back into the 5-minute chart, this is 15:05. So as you can see, with this we had a push up. 15:05, market reaches somewhere and comes down. Now the next hour for me is 4:45. So now we're going to be checking out this hour. Okay, if by 4:45 again we end up somewhere down, I want to, between 4:45 and 5:40, look to go up. Now because New York is in holiday, today is on an all-day holiday, I'm not sure if there'll be any action, because I doubt it. But on Friday, I don't work on Fridays, but I will check it out. If on Friday we are still in this zone, I will look to go long. Okay, why? Because it's a swing day, and I also have the hours for Friday, and I've posted all of June on the 21st of May. In fact, I'm about to post July as well, and it is the 19th of June. So I'm going to work on the last week of July and then post that up as well. So knowing the swing days and the swing hours, I can accordingly have a decent bias, and then I can see if market goes in my direction. Now if it does, my trades will be minimum risk. Okay, if it goes against me, it's minimum risk. If it goes in my favor, I've got good risk return ratio. So we're just going to trade on the hours at the right pricing as best we can. Now sometimes, let's take a look at this. Let's make this a little smaller. Now as you can see, this is a 5-minute chart, and this is Thursday. Now the low is here, the high is there. So entering a trade here is not the best place because it's in between levels, but you can do it on a breakout. So if the market does break out, like it's done here at the trading hour, going up, then it's okay. Once you do that, you can cover the trade quickly if it goes in your favor. If I had done this, if I'd said to myself, I'm going to use 1 bar stop loss, which I could have, then I could have covered the trade pretty much at 55. Let's see what that is. That's 48. So putting the stop loss on the 1 bar, I would have covered that trade if I did a 1 bar. Normally I do put a 1 bar actually. Okay, but it's a swing day, so the market can be a little volatile, and I don't mind taking $180 risk in order to get, you know, $700, $800 off the table. So it's okay. All right, and that's how it is. All right, so as the market pulls back into Thursday, Friday, I've got targets, and I've got price targets and time targets. So where they correlate, I'd like to get in with a tight stop loss to push my the price to the upside. And because US, like I said, is on a holiday, despite the fact that this is US pre-trade session right now, Okay, despite the fact that the US is on holiday, you see we have volatility here. All right, so we'll see how that pans out. The same thing can be for anything. This is SP 500. With SP 500, as you know, I'm looking to sell. I'm on the upside. You see the market is up. So on the swing days, Friday, Monday, Tuesday, and Thursday, Friday too, I'm looking to sell. All right, so this is all going to the downside as far as I'm concerned. Anyway, so all I have to do is put the trading hours. Let's see if this was a trading hour for today, Thursday, 11:30, 4:15, 4:40, 4:15. As you can see, 4:15 is the low. 4:15, 4:50, right? So market going up, and then we've got 11 o'clock is there. Okay, market making a bit of a headway, but remember we want to sell the indices, all right? Because why? Because the price is high. Okay, so the price is at the top here, so I want to sell it down, okay, and push it into the lows. And on the weekly as well, as you can see, you want to like go down. Okay, that's why. So my bias is to the downside, and at trading hours, if we're up somewhere, I don't mind selling. So if this was a trading hour, for example, I might have said to myself, impulse pullback, let's sell it off with a tight stop loss, and that's be fair enough. So then I can say to myself, if today wasn't a holiday in the US, I could have said, well, 225, 310, let's take a look. 225 is there, 3 is there. Okay, so on that bar, it's a 15-minute chart, and then I've got, if market turns, expect volatility to target 7 o'clock. Okay, you can see my comments here. Okay, but the US market is closed all day. All right, so it may not do that because there's no action. If there was, it would have highly likely done that. And that's 1900, and then we've got 2150. So we'd be looking to trade at those hours. Okay, so if we were up, I don't mind selling to the downside because the bias is to the downside. So basically this is all how it interacts, how we want to play the game, by using time and price together. So the art of trading it is when you have a breakout position, you'll get a clean risk return because your time is right. And normally, like I said, with these, when there's a breakout, I like to do a 1 bar stop loss. Okay, a 1 bar stop loss is sufficient. It will cover your trade. More often than not, you'll just get covered. You see, this is the trading hour where the breakout happened. Okay, this is 2:15 Thursday, 2:25 to 3:10. You see, 2:25 to 3:10. It's a 15-minute chart. It's a 5-minute chart. Sorry. 20:25. That's your breakout. Okay, so I had this on a 15-minute chart. That's why it's on 4:15. But the move, as you can see, is 2:25 to 3:10. Now, if you're using a 5-minute chart, you could do this as well. Okay, between those hours here. Now, if you've missed that breakout, that's fine. When it pulls back, you can still go long. What caused the breakout? Cause and consequence. This is the bar that caused it. This is why using normally a 1 bar stop loss will suffice if you enter quickly at a trading hour. Okay, if you are late, you can always wait for a pullback, especially here there's a gap, and this is the cause of the push, right? So market coming back to the cause and buying again will more often than not happen because market moves in waves, and they do like to come back and retest, especially if there's also a gap on a smaller time frame. Market kind of pulls back, so you don't have to rush your trade. So this time zone for us is important to get in, and then the next hours are also important, as you can see. So if we are anywhere low at a price or close to a price, also like a closing price and so on, we'd like to go up. Now, if the market comes back down again here, I'd be a bit, suspicious of it. Why? Because it's already done it once, twice, 3 times. So on 3 occasions we've gone back up from breaking the low of yesterday to pushing up. And because it's a swing day, you know, I want to go up. So at these low prices, you know, having a PST target zone like here with this pricing, which I'll put onto a 15-minute chart, you know, entering trades at decent hours to push up is okay. And you can do that with minimum risk, and that's the whole idea, by maximizing profit and minimizing risk. So your breakout positioning, you don't need to wait all day for it. You're going to be ready when it happens, because it's going to have to match time, because we're always matching time with price. And the other thing is, you've got a cleaner risk reward. More often than not, I put 1 bar stop losses on breakouts, because once it breaks out, it pushes, right? So if the time and price is right, if you got it right, then it should push. So, you know, putting a big stop loss doesn't really make sense. You can cover the trade quickly and then you can just let it go. If the 1 bar stop loss is too tight, because sometimes you get a small bar, then you can do it below the low of the most recent low on a 15-minute chart. And you have to check, obviously, if that's too far out, are you going to be able to cover it? Because I always like to cover trades. This is why I open 2 positions all the time. One covers the stop and the other one just goes off 1 to 6, 7, 8 risk reward ratio, because I can calculate the pricing on any time frame. So that allows me to get a decent target, which is logical and the market would like to get there. This way you'll avoid false breakouts, because you've got time and price on your side, and also you'll be confident. Okay, the market's going to be in chaos, but you understand this is a special time that you calculated. So with time and price going together, you know, if it breaks out in your direction, you'll more often than not cover the trade. And then you can, according to the other time frames as well, manage your trade. And this is a real innovation, because how do you normally manage your trade? According to price, right? So you're going to be putting your stop losses under support, resistance, or demand supply levels somewhere out there where the market, you know, is out of reach. However, though, if you've got time on your side, you can really work on your stop losses and you can keep them tight, because if you got the timing right, it should go in your direction. And if it doesn't, you don't want to be mucking around in that market. So what you can do, you can say to yourself, well, wait a minute, trading hours, despite the fact that we've got a swing day and want to push up, the market is selling from the highs. So do I want to take too much risk in this trade? Then you can say to yourself, you know what I'm going to do? This is the cause. I'm going to push the stop losses there, just under the cause, and leave it at that. Why? Because if my trading hours are correct, I shouldn't be crashing down. Okay, if I crash down, obviously I'm looking to go to another price and time correlation where I'll take another trade again. But the stop losses are so tight and your losses are so irrelevant that when you do make winnings, it's going to be a good rate. Also, with time price trading, you'll have a much higher accuracy rate. 70% is like a normal accuracy rate when using time and price logically with your trading. If you're consistently doing it, you should be just fine if you trade on a swing day, swing hour, price correlation. In fact, even more with some of the other stuff. Depends on also what you like to trade. I'm more of a gold person. I trade gold quite often. Even when the market is choppy, I like to go according to the bias, the swing day bias, in that direction at the trading hours. And more often than not, my trades will be really good. And even if they do turn pear-shaped, okay, like, you know, sometimes they'll go down and I will be wrong, and that's fine. The stop losses are really tight. And if I am right, as you can see on all of these, the market moved up when it came down. So these are the trade hours. Look, I'm looking to go up. I want to buy when the price is cheap. So market comes down. Okay, market goes up. So I don't want to be buying here at a trading hour because the market went up to it. So market comes back down again, so I can go back up again. Now with something like this in the middle of nowhere, your stop loss shouldn't be too far out. This is what I mean about a 1 bar stop loss. Here again, look, the market crashes into the trading hours, lifts up a little bit. This is still enough for you to cover the trade if you have a 1 bar stop loss, and that's really tight. Once again, market falls. If I buy again, you see it's already covering the trade, and you can put your stop loss up as well. Here as well, this is a bit scary because it's in the middle of nowhere, but if you think about it, this is also a breakout trade. So if I was trading gold today, okay, here, it's a breakout. This level is okay. It's a good buy kiss after the breakout. So if we were trading here, there's a gap here, I'd like to put the stop loss under the gap. Where's that 3,345 come from? It's from the daily PST 51, price of 3344.95, so 3,345 rounded up a little bit. So this price is hot. And do I want to buy here? It's not a bad idea, because I did say Tuesday is a swing day for gold, okay, and as long as we don't close under the low of Tuesday, okay, it's fine to buy stop sweeps at the trading hour, especially if it matches a PST level. I'm happy to do that. Now the weekly here has broken down, so if this is broken down, gold may have room to come down. Do I care? If I've got proper money management and if I'm trading at the right time and price, more often than not the trade should be covered, okay? So even if I'm entering a breakout here, that's the trading hour, that's the goodbye kiss, okay? And once the goodbye kiss happens, you can go in, okay? And that will more often than not cover your trade as well. If there are gaps, you need to be careful. That's obvious. So you know, that means money management. All right, so if you're going to put your stop loss under there, then you need to make sure that when you enter a trade here, you need to cover this stop loss somehow when the market moves up, and then obviously the rest is a free trade, and that's what we'd like to you know, look for. Covered trades going in our buys according to swing day and swing hour. So all you have to do is basically match those together, and when you do, you can break out at decent moments, and they're not surprises because you got time and price on your side. They're really anticipated. They happen at those hours. So you know, all you have to do is put your lines in place, trade them with time and price, tight stop, cover the trade, let the rest ride. Okay, so what you need to do is just make sure you use your timing correctly. So when you see these timing you know, the trading hours here, like Monday, Tuesday, Wednesday, Thursday, Friday, so I've got Friday here as well, and today is Thursday, so tomorrow will also be an interesting day because I'm looking at my book and I'm thinking Asia session is going to be good tomorrow. There's going to be volatility tomorrow in the Asia session, so this hour, my early morning hours tomorrow is going to be interesting, and I'd like to definitely look at getting into a trade, because if I find direction in the morning, it should take me all the way into 130 for a start, okay? And then if we have a breakout or a turn, okay, so at 135 we should have a breakout or a turnaround. Whichever happens, then it should take me all the way into 20 past 8, okay? And the evening can even go further into 11 o'clock. All right, so knowing these hours, as you can see, knowing these hours is a blessing, because you can now follow the trade according to hours as well. And if things are going to go pear-shaped, like at this euro dollar hour here, you already know about it, and you know it's an hour. So if it does go pear-shaped, you can put your stop even higher and say, you know what, I don't want to be in the flow of this pear-shaped trade, because that could go all the way down into this hour. So why take the risk? Okay, so obviously that's not a good thing. Obviously there are two things here. One is this trading hour, right, at 11:30 today. Now this 11:30 thingy-mob, whatchamacallit, 11:30, yeah, is an adjustment level. If this adjustment level, obviously you won't know that, okay, because you don't know how to time the market, but if you took it from me, you will know. That's your 11:30 there. All right, and that's the adjustment level, okay, from our, you know, timing evaluation. We know this is an adjusting zone. If this zone breaks down, you don't want to be in there anyway if you got your timing wrong. So now my risk was 180 bucks. Now we've come down to what, 116 bucks. Okay, so you can actually measure your risk, and you can also measure your potential wrong calculations, your correct calculations, not just with price but also with time. And I think this is really good for managing the trade, because you're not just stuck with price. You can take a look at things from a different perspective and measure the time as well. So breakout trades do happen often, and you can use them. When you use them with time and price, it's just, in my opinion, it's invaluable, because just being able to control your stop losses and manage your stop losses with time is an absolutely amazing thing. Because if I didn't know there was a time here and the market came up to it and then all of a sudden it banged down, I'd still be sitting with my stop losses all the way down here. That just doesn't make sense. Like, well, why would you want to do that? If this trading hour holds and this is just a mere retracement to get back in the game, okay, then you don't need to put your stop loss too far out. Keep it tight. If you get stopped out, you get stopped out with a smaller loss. All right, no big deal. And because today's a holiday, you'd probably think to yourself, you know what, I want to trade this Friday, because Friday we've got decent hours, decent setups, and if we find a good place where time and price meet, we'll go in on Friday. It's not a problem. So this is really an innovation, and you probably won't see anywhere else doing timing like this to the hour and the minute, where action really happens, where you can plan according to time and price. Righty, I hope that helps. This is the final video. We've come to the end of all the blog posts, articles and videos done. If you're interested, you can always drop me a line. I do post videos every now and then, but I think, like I said, covered everything that traders should need to know about time and price, and how to use time and price to solve every trader problem that you can possibly imagine and have. You can read all about it in the blog page here at globaltrader.club. If you go to the blog page, all right, so there's all of them. There are all the articles here, like from ages ago. Okay, so everything based on time and price, and there's a video for everything on my YouTube channel, so you can check it out. And if you're interested, you can follow me on x.com as well. No big deal. So all of these also, where is that series? I've done a series of 10 videos. Maybe I didn't write the articles for them, I'm not sure. Maybe I didn't. Okay, well, fair enough. There are also videos, a mini series of 10 video. Here they are. All right, trading problems from part 1 to part 10. Okay, they're also really good. This covers all of the problems that traders have and how you can solve it with time and price. Right, yeah. Hope that helps. Have a good day. All the best.